Well, good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Remember, if you have a question, it's likely that other listeners may have the same question, so we certainly encourage you to engage us. Now, based on some excellent feedback from our listeners, we've made some adjustments to the format of our weekly call. If you are a first-time listener and would like a little more information about our private client services and our philosophy of transparency, we have a separate webinar that will provide you with this on our website adjacent to this weekly webinar. Well, the Blue Jays, Hurricane Yakin, Taylor Swift, and the Run for the Cure were at the top of the list of trending Canadian Google searches last week, which puts all of our economic data in some context as to what people really care about. However, financial markets are not on everyone's radar screen, but they're certainly on ours. So let's look at what happened in financial markets last week. U.S. employment data was released last Friday, and it was certainly a big deal for financial markets, so let's have a little bit of a closer look. The headline number for the U.S. non-farm payroll data came in at 142,000, which was considerably lower than the expected 200,000 number. I often talk on my blog about how this number can be revised and re-revised in the coming months, so we will have to look further behind the headline number, which is likely to be changed in the next month's data. But we need to watch the trend, which does include revisions to previous months. So August number was revised lower by 37,000, and July's was revised down by another 22,000. The labor force participation rate continued to decline back to levels not seen since the late 1970s at a level of 62.4%. At that same time, the unemployment rate remained at 5.1%. Now, also importantly, average hourly earnings, they remained unchanged. So all in all, this is not showing the economic strength that had been anticipated and may potentially influence U.S. Federal Reserve policy, as it appears that, and as we at here at HighRock have been stressing, the U.S. economy does not have the economic backbone to weather the global economic decline. Well, other significant U.S. economic news included a continued slowing in manufacturing. When the ISM index moves below 50, it is considered to be in contraction, and historically this has been correlated with economic slowing. And the international trade data showed that exports continue to struggle against the backdrop of a weak global economy and a strong U.S. dollar. So how did financial markets react? Well, the U.S. 10-year bond yields dropped below 2% on Friday, but they moved back up on Monday to just a little over the 2% level, but they're hovering there as we speak. Interesting, the 3-month U.S. Treasury bills fell into negative territory. Now, when you think about it, you would be paying the U.S. Treasury to own their debt rather than be in cash. Now, that is telling us that there are some serious concerns about low inflation or even possible deflation, and that the Fed is not going to be raising rates anytime soon. With traders believing that the Fed's interest rate increase might be put on hold until possibly March of 2016 now, traders were buying up equities and drove prices significantly higher. Now, this is a relief rally, purely technical and likely short-term in nature. It should find some resistance at the 2000 to 2020 level on the S&P 500. Earnings season is beginning, and I'll talk on this topic a little further along in the webinar. In Canada, it was announced last week that real gross domestic product grew 0.3% in July after rising 0.4 in June. The growth in June and July followed 5 consecutive monthly declines from January to May. Now, the increase in July was led by mining, quarrying, and oil and gas extraction and manufacturing, and the finance and insurance sector. While this data is pretty old, back to July and June, it is the first look at what is happening in the third quarter and does point to a return to growth for the Canadian economy, and likely we've moved out of the mild recession of the first half of the year. Well, this better than expected performance certainly helped the Canadian dollar bounce back from its recent lows, and with some recent stability in commodity prices, the TSX moved higher on the week, but still certainly within the downtrend which began back in May. In other economic news, negotiators for the 12-member countries of the Trans-Pacific Partnership struck a tentative deal in Atlanta early Monday morning, and that will eliminate or sharply reduce most tariffs in a region spanning roughly 40% of the global economy. That's a big deal. For Canada, the big gains are in Japan, the world's #3 economy, as well as in Malaysia and Vietnam. All three countries have relatively high tariffs on Canadian exports, including beef, pork, canola, oil, barley, forest products, and aerospace. So tariffs on these items will be eliminated or sharply reduced, some immediately and the rest over the next 10 to 15 years. So a bit of a long-term situation, but something that Canada definitely needed to be a part of. Also last week, National Bank of Canada announced job cuts and a new share offering in a surprise move that acknowledged that volatile markets and shifting consumer preferences for the way they conduct their banking. The head of the National Bank, Mr. Vachon, said that volatile markets were also to blame for the decision to raise money, since lower notional values for bond holdings, for example, eroded the bank's common equity Tier 1 ratio, a measure of financial strength, to 9.5%, or right at the minimum required by domestic regulators. The share offering will provide a buffer by boosting the ratio to an estimated 9.8% by the end of October. On Wednesday, the Globe and Mail reported that the Bank of Nova Scotia had raised its cost-cutting goal within its domestic operations, adding to concerns that Canadian banks are looking at expenses amid slowing economic growth and technology-driven changes. Paul, do you think that there's any risk here for other Canadian banks?
Yeah, I think this is going to be something we're going to see more of, Scott. In National Bank's case in particular, they have a very high weight of energy-related loans outstanding versus their total loans. So that's problematic for them. But we're going into a little detail. The Canadian banking situation is a whole bunch different today than it was a number of years ago. And that really is because of what's going on around the world with Basel III, which is sort of the global bank regulator, making some changes as to how banks calculate their common equity and Tier 1 ratios, and also how the Government of Canada, the Minister of Finance, the Bank of Canada, and the Office of the Superintendent of Financial Institutions, which is our national regulator, calculate those ratios. And I think, again, without going into detail on it, what you're going to see is more share issuance, more what's called NVCC, non-viability contingent capital, which are subordinate and senior debt issuance. And all of these things can turn into equity capital if there is a real liquidity problem with the bank in Canada. So in the end, what that means for us as investors is we'll probably see more share issuances, more preferred shares. Well, actually, they don't even do preferred shares anymore. More subordinate debt issues, et cetera, that count as common equity. And it will make the bank stocks, in particular, more volatile. And again, I won't go into any more detail than that, but we'll probably see more share issuances at times, and bank stocks will be more volatile because of this these new rules.
Thanks, Paul. That's great. Thanks for the update. Let's look at what's going on around the global economy. Today, the IMF released their latest World Economic Outlook, and this tells us that there's an expectation for lower global growth compared to last year, with a modest pickup in advanced economies and a slowing in the emerging markets, primarily reflecting weakness in some large emerging economies and oil exporting countries. Now, these forecasts reflect a world economy that is at the intersection of at least three powerful forces, according to Maurice Obstfeld, the IMF economic counselor and director of the research department. First, China's economic transformation away from export and investment-led growth and manufacturing in favor of greater focus on domestic consumption and services. Second, and related, the fall in commodity prices. And third, the impending increase in U.S. interest rates, which could have global repercussions and add to current uncertainties. Global real GDP grew at a 3.4% rate last year and is forecast to grow at only 3.1% this year, but growth is expected to rebound to 3.6% next year. Growth in advanced economies is projected to increase modestly to 2% this year and 2.2% next. This year's pickup reflects primarily the strengthening of the modest recovery in the euro area and a return to positive growth in Japan, supported by declining oil prices, accommodative monetary policy, and improved financial conditions, and in some cases, currency depreciation. Now, while growth is expected to increase in 2016, especially in North America, medium-term prospects remain subdued, reflecting a combination of lower investment, unfavorable demographics, and weak productivity growth. Growth prospects in emerging markets and developing economies vary across countries and regions, but the outlook for 2015 is generally weakening, with growth for these economies as a group projected to decline from 4.6% in 2014 to 4% in 2015. The fifth straight year of slowing growth reflects a combination of factors: weaker growth in oil exporters, a slowdown in China with less reliance on commodity-intensive investment, adjustment in the aftermath of credit and investment booms, and a weaker outlook for exporters of other commodities, including in Latin America, following declines in their export prices. In addition, geopolitical tensions and domestic strife in a number of countries remain high, with potential economic and social costs. So how does all of this interact with our HIROC themes for 2015? The IMF says that downside risks are more significant. Given the distribution of risks to the near-term outlook, global growth is more likely to fall short of expectations than to surprise on the upside. Well, that certainly falls into our key theme. The World Economic Outlook report outlines important shifts that could stall global recovery, and these include lower oil and other commodity prices, which, although benefiting commodity importers, can complicate the outlook for commodity exporters, some of whom already face strained initial conditions. A sharper than expected slowdown in China, if the expected rebalancing toward a more market-based and consumption-driven growth proves more challenging than expected. Certainly disruptive asset price shifts and a further increase in financial market volatility could involve a reversal of capital flows in emerging market countries, and we've already seen that beginning. Further renewed concerns about China's growth potential, Greece's future in the euro area, and the impact of sharply lower oil prices and contagion effects could be sparks for further market volatility. As well, a further appreciation of the U.S. dollar, and we've talked about this a lot in the past, it could pose balance sheet and funding risks for dollar debtors, especially in some emerging market economies where foreign currency corporate debt has increased substantially over the past few years. So all of these things are definitely things that we've been talking about on a regular basis, and certainly the IMF is corroborating a lot of what we've been suggesting is the path forward. So let's see what bond markets are telling us at this particular point in time. Bond markets, which we've often said lead other financial markets, continue to tell us that inflation expectations are low because the prospects for economic growth are low. As we've been showing you for many weeks, short-term German yields are actually in negative territory out to 5 years. I thought it might be interesting to compare the various country yield curves to help understand how things look for some of the advanced economies. Now, yields or interest rates are on the vertical axis. The term to maturity is on the horizontal axis. We've shown these yield curves individually in the past, but here's the comparison. Certainly, Japan has the lowest rates as they've been had to endure close to 20 years of inflation. Although, again, German yields out to 5 years are negative. Interestingly,
yep. Scott, just going to interrupt. Over 20 years of deflation in Japan. I think you said inflation.
Oh, sorry. Yes, sorry. I meant to say deflation.
Apologies.
I didn't say that. Thanks for correcting me. Certainly, bond investors are obviously not expecting inflation to reach the 2% targets for some time into the future, as the highest yield is in the U.S. and it moves above 2% at the 10-year maturity level. So it's economic growth that creates inflation, and as the IMF said, they continue to see low growth. So it's not hard to see what bond markets are telling us as we move forward. Another thing that we monitor closely is how high-yield bonds trade, as they have in the past been a leading indicator for the direction of equity markets. And in this case, we're seeing some considerable divergence as equity markets bounced higher following the U.S. employment data last Friday, but high-yield bonds have really not moved that much, just up a little bit. For us, this is telling us that the equity market bounce is perhaps overdone, and that we should continue to exercise caution. But equity markets, obviously, they haven't quite figured it out. Share buybacks, low interest rates drove equity prices to levels that were not supported by better fundamentals to reach their highs last May. And this has been an ongoing theme for us here at Highrock. We have been adamant that equities have been too expensive since we began these webinars last April. The 10-year average price to earnings ratio is currently at 14.1. The current forward 12-month average is 15.1, and last May it peaked at 17. So equity prices have been moving lower since. They are getting cheaper, but we still think that they remain overvalued. Now we're at the beginning of third quarter earnings, as I mentioned earlier, and we expect to see announcements starting to roll out. The expectations are for earnings in aggregate to have declined by approximately 5%. And we'll follow the progress of these earnings over the course of the next few weeks. But if they do, in fact, come in negative territory, it would be the first back-to-back earnings, back-to-back negative earnings quarters since 2009. S&P 500 companies are valued at current market prices at 11.75 times. The 10-year average is 10.25 times. One of the Canadian companies we own in our tactical growth model has been the subject of a takeover at actually at 8.5 times, and that's the green line that you see on the chart. Paul will talk about this in a little more detail further on in the call, but the point here is how expensive S&P 500 companies are relative to their real value. This should tell you why we're not anxious to put our clients' money to work, or our own money and our clients' money to work at these particular prices. From a value perspective, it just doesn't make any sense to us. Last week, we pointed out that, the relevance of margin debt as another leading indicator of equity price movement. Investors who borrow or use leverage to buy equities, they're okay until they start to see the value of the collateral they're using decline. When asset prices drop, lenders either want more margin or they want the borrowers to pay down their debt, which means that the borrowers need to raise cash. They do this by selling assets, and in some cases they're usually the most profitable assets and usually the most liquid assets. But this selling increases volatility and uncertainty. Historically, a decline in margin debt, as we saw in 2007, 2008, leads equity prices lower. After record levels of margin debt earlier this year, we could be seeing similar margin-related equity selling at this point in time. Well, from the highs in May to the lows in August, the S&P 500 dropped 12.3%. At current levels is down about 7.3% from the highs. And while fundamentally prices have been getting cheaper, they're still expensive by historical standards. We'd not be surprised if the S&P 500 fell by up to 20% from its highs. And that is where we would be comfortable to do buying of this particular asset class. I've talked about this regularly, but as portfolio managers with long-term perspective, we believe that markets are cyclical. We are well off the recent cyclical highs for equity markets. However, it's not exactly clear how far we are into this cyclical downturn. We expect that it's going to move a little bit further, but we are watching closely as how markets are behaving. But it's not necessarily about the economy, but it is certainly about the perception of what is to come next. That's where our understanding of behavioral finance enters the equation. We need to determine the current psychology of the market and look for the buying opportunities when they present themselves. Well, all of the discussion today outlines our continuing view that with low economic growth, low earnings, low commodity prices, low inflation, low interest rates, we're going to continue to be in a low return environment, and investors will need to continue to adjust their expectation to that reality. But with that in mind, we need to stay focused on getting good risk-adjusted returns and not be driven to chasing higher returns at the expense of adding risk to our client portfolios. Now at High Rock, we use 3 investment models with which to build our balanced portfolios. Our fixed income model is comprised of 4 sub-asset classes. AAA government bonds are the safest asset that we'll own. They're a hedge against inflation and temporarily able to offset any short-term spikes in equity market volatility. We've been adding to these positions gradually as opportunities present themselves. High-quality corporate investment-grade bonds also protect against deflation and add yield to the average bond return. We've been watching opportunities develop to purchase these bonds, but have not been active yet in this asset class. We often talk on this call about the excellent risk-adjusted returns of high-yield bonds that are not correlated to interest rate movements like other bonds. We like that diversification and have dedicated an allocation to them. Finally, we like the tax efficiency of dividends, and we can get these from fixed-rate perpetual preferred shares. We'll only buy the best quality financial institutions and avoid the fixed-rate reset preferred shares that have lower yields and shorter maturity horizons. As I mentioned last week, preferred shares have moved significantly lower this year, and there are some opportunities coming, but tax loss selling season is going to allow us to be patient as it may push prices just a little lower still. In our global equity model, our objective is broad diversity across many different geographical locations and economic sectors. Remember that we buy companies and not countries through the exchange-traded funds that we invest in, and that percentage weights will and may change at any time if we see advantages in doing so. We also seek to find the lowest cost ETFs as is possible. We will also own some of these ETFs in US dollars or have cash in US dollars because when the world gets volatile, the US dollar is a safe haven, and this can drive the value of the US dollar higher, which reduces the impact of volatility on the portfolio. Our third model is made up of usually small to mid-sized Canadian companies that we believe, through our in-depth research, may have outstanding growth potential. This could hold up to 10 names and may in fact hold U.S. companies as well if we see the potential value of doing so. At the moment, we own 3 companies in this model, and the balance is in cash. Now, Paul, would you like to update our listeners as to what's been going on in this part of the portfolio, especially with some news today?
Sure, and I won't be specific on the news, but we did have one of those 3 portfolio companies that we own in the Canadian equity model. It looks like it's being taken out by another company that we know very well, In fact, that company, the acquiring company, we were looking at buying stock in it. This acquisition is all share swap, so we're not actually getting paid cash for it. We're going to end up with stock in the acquiring company and the company that we were looking to buy stock in anyway. So a pretty good thing. Scott, you mentioned the S&P 500 multiple trading at EV to EBITDA around 11.25, just so our listeners are aware. And this is a value trade more than anything else, so a lot of research went into the trade. But the acquisition took place at 8.5 times EBITDA, and the S&P 500 on average is trading at 11.25 times. So that's pretty significant difference. Boy, if it was taken at 11.25 times, we'd be you'd have to kill us off the ceiling. Anyway, there are still opportunities out there, but the overriding issue becomes volatility. So we need to pick and choose and be careful in here. So nonetheless, a good day for all of our portfolios.
Yeah, that's great. Thanks, Paul. So just as a reminder, a client portfolio, depending on their goals, objectives, risk tolerance, and their wealth forecast, may strategically comprise all or some of these models in varying degrees. Don't forget, Paul and I own the same models in varying mixes. My 60% equity and 40% fixed income balance is 40% of the fixed income model, 50% of the global equity model, and 10% of the Canadian growth model. Paul's, in contrast, is skewed more to the growth equity, but also has more fixed income to provide balance. As well, a more conservative balance might have a 60% or even 70% fixed income weight, really dependent upon what a client's wealth forecast tells us that they need. Remember that these are all target allocations, and as cash flows into a portfolio, or if it flows out for cash flow needs, it requires a portfolio rebalancing. And this means that we need to apply our disciplined approach to buying and selling, which also means that at any given time, our portfolios may not be fully invested, but we are always working to achieve the target weightings, but at the appropriate prices, which is very important. Our research shows, and I've gone over this many times, but that over time, a well-balanced portfolio will give an investor better risk-adjusted returns than some of the equity indices like the S&P 500 or the TSX will. Okay, well, how does performance compare after another week? In my portfolio, with my particular structure, U.S. companies comprise about 18% of the 60% equity, 40% fixed income mix. While the S&P 500 is up 5.2% from last Tuesday, and on the year is down 3.5%. Canadian companies in our global model are approximately 9% of my 60-40 mix. The S&P TSX is up 4.7% this week, but down 7.4% on the year to date. Euro area companies represent about 4% of my 60-40 mix. The Euro Stoxx 50 was up 7.8% this week and is up 1.4% on the year. Japanese companies are about 3% of my 60-40 portfolio. The Nikkei 225 is up by 7.4% this week and 3.2% so far this year. UK companies represent 2.5% of my 60-40 portfolio. The FTSE 100 is up 7% this week and down 3.8% on the year. Australian companies represent less than 1% of my 60-40 portfolio. This week, the Australian All Ordinaries Index is up by 4.9%, on the year down by 3.8%. As for China and other emerging market companies, which represent about 3% of my 60-40 portfolio, China's Shanghai Composite has been closed since last Tuesday, but it is down 5.5% on the year. The emerging markets ETF that we buy for our model is down about 3.2% on the year. So by comparison, my 60/40 portfolio, which is comprised of our 3 models, is up by a little under 1.5% so far this year. All right, well, that's it for today's discussion. If anyone might have a question, please feel free to ask it now.
I have a question. It's regarding, like, early on in your presentation about the tariffs. So, if you can you comment on this, because how is this going to work to the North American benefit? Because in my mind, it's cheaper to produce things overseas, and then you take away the tariffs. Like, isn't it taking a lot of jobs away, and also our exports would potentially decrease because it's more expensive to produce things in North America? You know what I'm saying?
Yeah, and I think if we look very closely at how the deal is structured, it really is reducing tariffs on U.S. and Canadian exports, things that we do export. So it benefits exporters in the respective countries. So in Canada specifically, agriculture, as well as some raw materials and energy exports.
Okay.
I couldn't get into the absolute detail about what the benefits are going to be in the U.S., but you're right, there will be some displacement. I've been reading about how it's going to impact Canadian dairy farmers in a negative way,
right,
because of the ability for more competition among those trading partners. But all of these things come together, end up in the long run being beneficial for most countries, because otherwise they wouldn't enter into these agreements. So really, I think the intent is to help where those respective countries are strong from exports, so that they focus on their on the things that they do well, as opposed to subsidizing industries that don't do well in the respective countries.
Okay.
But an excellent question. Really testing my economics, Kathy.
Sorry.
No worries, no worries. Anybody else have a question for us today?
I do. Scott, maybe you can explain or elaborate a little bit more on 2 things. Number one, what you mean by rebalancing, when you rebalance portfolios, and number 2, you also commented and mentioned a little bit on, the models that we have and how our clients and even ourselves are getting invested towards the models. Like, it takes time, and maybe you could explain both those things.
Sure. There's 3 things that might create a need to rebalance a portfolio. So I'll start with those. The first thing is when a particular asset class that we hold gets out of its target weighting. So, for example, if we want to hold 18% U.S. equities, but the strength in the U.S. equity market pushes the value of that asset class higher, so that it's 23 or 24%, a rebalancing is required to take the profit on the overweight part. So you sell the 4 or 5% that it has become overweight, take the profit, and use that cash to reinvest in assets that are underperforming, because in time the different asset classes will through the cycle will rebalance themselves, and that will be advantageous and add value to the client's portfolio. Also, when a client is adding and building their portfolio, they're adding cash, they have savings they want to put into their portfolio, obviously that means that everything becomes underweight, and we have to find opportunities with which to add assets and utilize that cash. So again, we'll be looking for opportunities. I'll get to that, the discipline of the investing part in a second. When clients need cash, some clients require cash flow from their portfolios. Of course, we have to raise cash for them. It means we have to sell certain assets. We want to have enough cash in a client portfolio that we're not forced to sell an asset, especially when that asset might be temporarily undervalued. So we're always wanting to maintain a cash balance in order to assist clients with their cash needs. So I hope that's fairly clear about what rebalancing requirements or what would require rebalancing. Now, when we rebalance, and as I was saying before, it will require potentially purchases of assets or sales of assets. But again, we have a very disciplined approach, and we use not only our fundamental perspective on what the economies are telling us as to the timing of some of these purchases and sales. We also use the technical indicators too, and as I said before, gauging when a market is overbought or oversold and trying not to participate at the wrong time. So we do use our expertise to add value. We're not trying to time markets specifically, but we are trying to add value in the timing of making purchases and sales when required. And I hope that answers all those questions.
Indeed, thank you.
Okay. So we've run a little bit over our time this week, folks, so I'm going to cut the questions off there. But if you do have questions and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on what you think of these webinars. If there's anything that you like or anything you want us to add, then certainly we'd appreciate that input. But that's it for another week. Thanks for taking the time to tune in. Have a great rest of the week. Have a happy Canadian Thanksgiving. And let's go Blue Jays. We'll be back with another report next Tuesday. This is Scott Tomlinson signing off.